All right, well, good afternoon, everybody. Thanks for having us. Panelists, come on up. I hope everyone had a good lunch, already had a good start to the day, and let's pick the liveliest topic we can, fixed income, for the afternoon. Joking aside, actually, 2024 has been one of the more interesting ones when you think about what's happened across the fixed income landscape. Traditionally, as markets recover, as economies do well, you think that bond portfolios do well also. But given the amount of central bank activity, the questions around inflation, around rates, there's really just a lot of uncertainty that's happened. And as a result, it's been actually challenging to manage what's been arguably the cornerstone of most portfolios. So today I've got a panel of very talented individuals up here representing some phenomenal firms that's going to talk more about, well, what's happening in the fixed income landscape, where are the opportunities, more specifically within ETFs, an area that some have embraced, some have actually shunned for fixed income. We're just going to unpack a lot of what's going on, and hopefully we have a few minutes at the end of this for questions for everybody. So to start it off, I would like to ask that everybody introduce themselves and a little background on where their firm sits in the fixed income ETF landscape.
Sure. Good to be here. Thank you for having me. Tanuj Dora, I work at PIMCO, managing a few fixed income ETFs, and I also head the ETF capital markets function.
Krishna Kumar, I run a firm called Goose Hollow Capital. We have a bunch of active ETFs, including a fixed income ETF.
Connor Stack from BlackRock and iShares, and I work on our fixed income product strategy team, both working internally on strategy for the overall fixed income ETF platform, but also working externally, working with our investors and clients, institutional, wealth, and retail, on how to implement their investment strategies using our fixed income ETFs.
Thanks for having me. Hugo Egmaniki. I work at Jane Street, sitting on our institutional sales and trading desk. For those of you that don't know, Jane Street is a liquidity provider across the ETF space, but also within the underlying fixed income universe.
Great. Well, the easy first question is, what are your views on fixed income? It's been pretty varied. Obviously, the Fed's had a lot of play into where outlook is sitting and expectations, but to hear each of your firm's views would be great, just to set the stage for today's conversation.
Sure. So PIMCO is a pretty large, big bond manager, and unsurprisingly, our views are pretty bullish on fixed income. But I think there's good reason for that optimism right now. You have starting level yields, which are really attractive, as attractive as they've been in over a decade. Risk-free rates, nominal yields well above 5%, real yields above 2%. You can get good, high-quality fixed income exposure. Get a yield of 6-7%. That's really attractive. We're not very well known for our equity forecasts, but if you look at all Wall Street forecasts right now, you'll be hard-pressed to find that kind of return potential, which you do in fixed income right now. And then if you were to risk adjust those returns, on a risk adjusted basis, fixed income has like a fraction of the volatility of equities. Those returns and return potential looks even more compelling. The other thing which I'd mention about those starting level high yields is that a lot of people were kind of hard done by 2022 when stocks and bonds kind of tanked both at the same time. That happened for a good reason. That was Fed pulling years of stimulus away from the markets. Now you have a Fed which is a lot more data dependent. In that environment, we think fixed income duration does what it's supposed to do. It's also to provide diversification to your portfolio. It's supposed to provide that shock absorber, when there is a downside in the market. So from a starting level yield perspective to the diversification perspective, it gives us reason to be very optimistic.
Krishna, Goose Hollow, you look a lot into the macro and what's going on in the markets. What are you guys thinking these days?
Yeah, I have to agree with what my colleague here has said from a much larger firm. But I think there's two things to think about, right? The first thing, as he correctly pointed out, we're starting with much higher real interest rates. So you have a positive real interest rate anywhere in the world. You are also in a place now where even high yield and other markets, you got enough margin of safety, right? Fixed income 3 years ago, remember when 2-year notes were at 10 basis points, it was basically return-free risk, right? You didn't get any return, you had all the risks that you could get. Now it's, much more meaningful part of the portfolio. But I should say, like, just to disagree with him on something, the risk to everything we have, whether we have equities or any asset we own, is the fact that we're wrong, right? That Tanuj is wrong and other folks who are bullish on fixed income are wrong. Because imagine a scenario where inflation actually comes back and Fed has to tighten again. I don't think fixed income is going to be as friendly in that environment. So where I'm going with this is I think it's time for more active sort of fixed income exposure. I think a lot of people are quite happy with cash at the moment, but I do think that given the macro backdrop we have, where inflation could come back, not necessarily this month, but in the next year, and then you're going to get the same sort of surprise in fixed income, right? So I think we're a bit more friendlier fixed income environment. We own a lot of things in fixed income. We think having a broad portfolio of various parts of the fixed income market makes sense, but it's also a good time to always bear in mind that interest rates are high, but they're not like crazy high, right? So you could easily see real interest rates go from +2 to +4, and that could be pretty bad, right? So we kind of constantly look for hedges in the book. So we like to own the assets we like to own, and then have some hedges on top.
Yeah.
Go ahead, Connor.
Yeah, Jason, I might answer the question a little bit differently, actually. And when you ask, what is your view on fixed income markets and what is your outlook? It's a very broad question. Fixed income is a very broad asset class. It's kind of like asking, what is your view on markets going forward? I mean, are you talking short duration? Are you talking long duration? Are you talking credit risk or no credit risk? Which sector? Which risk profile? Which part of the market? And the way I want to answer the question is, what we're seeing right now is at least, and you could very much make the argument that today is the best time in history to be a fixed income investor from coming at it from two angles. One is the opportunity that they just mentioned, which is yields today are at the highest levels that they've been in at least a decade, maybe multiple decades, depending on which part of the fixed income market you're looking at. And that's true in both nominal terms and in real terms, the yields that you can lock in today going forward. And as we know, as fixed income investors, the biggest determinant of future performance is your starting yield, in addition to whatever active performance that you can add on top of it. So from just a starting point standpoint, at least in the medium to long term, of course there'll be volatility in the short term, it is one of the best environments that we in this room have ever had investing in fixed income markets. But the second part of it is, this is really the best time in history from a toolkit standpoint to access the opportunity that exists today. And that's true from a number of different angles, whether you're a CIO and you can invest in public fixed income markets or private debt markets. It's true if you're a portfolio manager, a fixed income portfolio manager who used to maybe only be able to use individual bonds to build their portfolios, but today they can use things like portfolio trades, they can use ETFs, they can use CDX, they can use swaps. And it's true from the investor perspective, because there are hundreds of fixed income ETFs in the US alone at this point across the entire spectrum. And there's tools that all of those investors can use to take advantage of this opportunity that we have today that they maybe didn't have, or at least didn't have to this extent. And we'll get into what some of those tools are exactly shortly. But the combination of both those things, yield levels and the toolkit that all of us in this room and BlackRock and others have provided, combine those two together, and it's really powerful.
Hugo, I know your firm's got a little bit of a different take. You're a liquidity provider. You're actually making these things function in size and working in the marketplace. But what are you seeing materialize as far as trading activity? I mean, we've heard a lot of sort of general themes on fixed income. What does your desk tend to see in this space?
So it's interesting because I do agree with Connor to the extent that private markets are involved. And I think the first way I would answer that question is that there is this increasing sort of bifurcation of the fixed income markets where you have public markets and sort of the dynamic changes that have occurred there, whether it's electronic trading, exchange trading, ETFs, but also portfolio trading. On the other end, you have the growth of private markets, and that's particularly had an influence on companies that originally were financing within the high yield corporate bond space. So that has serious implications not only for the supply of available issuers coming to market within the high yield space, that also has serious implications for liquidity down the line, particularly because you've seen from the asset owner community this sort of growth and exposure in their portfolios to the alt space. And eventually, at some point, they will need liquidity to sort of facilitate that part of their portfolios. The other part, looking at the ETF space, is that yes, absolutely, from a portfolio trading perspective, from a growth of electronic trading perspective, these three different ecosystems sort of work together with ETFs to now create this massive toolkit for institutional investors where they can sort of pick and play where they want to be in the market. That being said, because of the rate environment where we've seen sort of the greatest, I would say, fraction of flows coming in is still within the ultra short duration space, probably second only really to ag, right? So people are capturing sort of the advantage of short-term interest rates right now, and they're using whether it's single bond treasury ETFs or diversified portfolios within treasury ETFs. But all that to say that there's still a good amount of cash sitting on the sidelines. When you look past that, there is increasingly now a push from institutional investors to understand what else can fit within the ETF wrapper. And I think that then goes back to private markets. But in the last year, we've seen additional CLO ETFs come into the space as a means of providing liquidity. So all that to say, yes, ETF growth is great, but I think this is still a very weird time for how fixed income markets are changing between public and private markets.
I think you hit an interesting point too. I mean, as you think about where fixed income ETFs were a decade ago, and it was you're buying the ag, you're buying these broad sort of swaths of the fixed income market. That was it, and now it's definitely evolved a lot. I mean, we've talked about already today the amount of new ETFs coming out this year, last year, the evolution, obviously active and passive, and we'll touch on that later. But just in general, I mean, where do you see sort of the fixed income landscape for ETFs heading? Because it's the days of buying the ag and that's it. It's changed. We've evolved, and we're always trying to figure out how do we stay on the cutting edge of this evolution and keep enhancing our portfolios.
Yeah, I'll take that. So, I mentioned we have hundreds of ETFs in fixed income in the U.S. today. BlackRock and iShares alone have 130 different fixed income ETFs. So clearly the conversation has evolved from just talking about the ag, which, by the way, is still our most popular strategy. In fact, I think AGG, the plain vanilla core bond ETF, is the largest fixed income ETF asset gatherer year to date. So there's still clearly a lot of demand for that and the ability to get low cost access to fixed income markets. But then you start to peel back the onion and take it a step further. And I come at it from a couple of different angles. The first is granularity. So cracking open the ag and saying, okay, I don't want to just own the broad bond market. I want to own just corporates, or I want to overweight mortgage-backed securities, or I want to dive into treasuries and where I want to be in the curve, whether it's short duration or long duration, or putting on a barbell or a bullet in the intermediate. So there's granularity, and that's even now going a step further into, okay, within corporates, maybe I am going to target a specific rating segment. Or maybe within treasuries, I want just the 1 to 3 year part of the curve, or just the 7 to 10 year part of the curve. So we'll continue to get more and more granular. And then we'll also move away from the ag into sectors of the fixed income market that you couldn't access historically. And Hugo mentioned CLOs. So the ETF has really democratized access to more investors to CLOs. This is a sector of fixed income markets that historically only the largest institutional investors had access to by maybe coming to someone like BlackRock and giving us a couple $100 million for a separate account or large institutional account. Now you can get access to the benefits that CLOs bring to a portfolio for the cost of a share price on exchange for a very low fee. And there's other sectors outside of the ag as well, whether it's floating rate, so fixed rate makes up the entirety of the ag. There's floating rate, both on the lower risk end of the spectrum, floating rate treasury securities, to the riskiest end of the spectrum, which would be bank loans, and to other geographies, so going outside the U.S. As well. And then the third area that I would say is, and this was discussed earlier on in a couple of the other panels, but bringing outcomes to more investors. So not just saying, okay, I want exposure to this part of the fixed income market, but I'm looking for an outcome. I'm looking for income in my portfolio. I'm looking for downside protection. I'm looking for hedging out specific risk, whether it's inflation risk or interest rate risk, and utilizing derivative overlay strategies within the ETF vehicle. And so any really way that you want to get, reach your objective or get an outcome, you can now do in the ETF, and that's a third angle that we're seeing it come from as well.
I agree with all those comments. There's various different ways and use cases of how fixed income ETFs have been used, but I also think that it's the use cases have been determined by what's out there. I think a few years back you mentioned it was like these passive low cost was kind of synonymous with ETFs, and I think there was a little bit of an equities overhang over there. We at PIMCO, we've had an active fixed income ETF from way back in 2009, but a lot of managers came into the ETF space. Active fixed income managers came into the space post the 2019 ETF rule, and it's not that the demand for active fixed income wasn't there before. If you look at mutual fund landscape, more money in active versus passive. And there's a reason for that. Active managers have historically outperformed benchmarks. So there was this demand. So the other dimension I would add to that, and in that changing landscape, is you don't necessarily need to give, whether it's a tactical sleeve allocation or a broad mandate allocation, you don't necessarily need to rely on the Barclays Ag. You don't necessarily need to rely on benchmark-focused credit indices. You can get more of an active discretion in both tactical and broad mandate accounts.
Krishna, how about you guys both allocate and you're a manufacturer, you get an interesting perspective on the markets usually?
Yeah, no, I think we use their products, we use a lot of BlackRock products, and PIMCO is obviously a great firm. The thing that I think is changing with what we are doing in small firms like us is that we're trying to make it more appealing in terms of complexity, right? So if you go back in time, from the 2008 to 2020 period, it was the longest economic cycle we had in a long time, right? And if you go further back in time when you have much higher inflation environments, the economic cycle tends to be very short. So you get a 4 or 5 year cycle, which means that the Fed hikes, then things slow down, then they have to cut, and so on. So when you have a long expansion and rates are low for a long time, you could just be in passive fixed income and just be indexed, and you probably did okay. But I think going forward in time, you're going to have to rotate around things. And I think that's where I think a lot of innovation is going to happen. And of course, in our ETF, we can use all sorts of derivatives in it. We can have curve caps and all sorts of other complex products when it makes sense. So I think as all those things become available, that whole universe will get much bigger. I think this passive thing, we've oversold passive to investors. And I think at some point people are going to turn around and say it doesn't work. We're seeing that in fixed income already. Like the people we've spoken to are all like, oh, we have not been able to figure out what to do in fixed income, right? I think it'll happen in equities as well, where people are going to be like, listen, this idea of things going up 15% every year, it just doesn't make sense. So at some point, we're going to get the change, and I think it comes because the inflationary environment we're in is different. We're going to get like some weaker inflation prints, and then we're going to again start getting inflation back, and so it's not going to be a very simple process where the Fed's going to go from 5.5% to 1%, right? They're going to maybe cut a couple of times, then they might sit on their hands, and then they might have to hike again, and so I think this is where I think active management might help.
Always the slightly different perspective, but I'm also curious too, not just the evolution of the products, but where the funds are coming from too. Has that evolved as well? So, Hugo,
Where the funds are coming from in terms of investors or from
investors and sort of who's coming into it, and products-wise too. If there's other sort of interesting things that you're seeing as those flows.
Yeah,
are
I mean,
ramping
I think
up.
from a product development perspective with the issuers, there's definitely sort of this never-ending need to figure out ways to slice up the fixed income market and to further develop this sort of toolbox or tool set for investors. That being said, I don't know the extent to which investors are ready to engage within these respective spaces. So we've sort of seen this play out, particularly with high yield ETFs and high yield sector ETFs, and this idea that you would have institutional investors finally utilize this toolbox that was available to them. And frankly, the flows didn't really materialize as much as expected. Where you did see flows sort of materialize with newer fixed income products was still within sort of this ultra short space, the core plus bond space, and then the ag space. So there's still a little bit of, I would say, traditionalism when it comes to institutional investors within the space. But going back to this idea of active versus passive within fixed income, I don't know if it's too radical to say that there is no such thing as passive within fixed income. It's always been optimized to some degree. And I think it's really important for people to know that when these indices were developed, they were largely developed to be academic indices as a means of measuring the market. It is impossible to fully replicate a fixed income index. So flash forward to what you're seeing now with active managers that are increasingly interested in the fixed income space. They're still utilizing a lot of the workflows and the toolboxes that were developed by, quote unquote, their index or their passive peers in terms of managing these funds. And what I mean by that is, for instance, with the ETF rule, custom basket solutions, where market makers are delivering not identical baskets to what's being held in the fund, but baskets that are designed to help the PMs get to where they need to be, whether it's from a duration perspective, a sector perspective, or quality perspective. And I think for active managers now coming into this space, they sort of have to wrestle with this idea of, what we thought initially might have been a secret sauce in terms of our strategy. They're realizing that they have to kind of open up those parameters to other market participants, namely the market makers and the APs that are involved in delivering these custom baskets, so that we are now utilizing our balance sheets as a means of them accessing that risk. And by the way, they're doing so in a tax-efficient manner with the custom basket process, with creation and redemption. So I just see it more so as an evolution, not a sort of passive versus active.
Yeah, I couldn't agree more here, and there's a couple questions I think worth hitting on, but we at BlackRock don't even use the word passive. It's index and active, and then oftentimes it's active via index. And to Hugo's point, first of all, there's nothing passive about the way we even manage an index fund, because it takes a lot of work and effort to provide index-like returns in a asset class like fixed income. So the U.S. aggregate index has 10,000 securities in it. We're not going to be able to buy and turn over all 10,000 securities in that index. But by owning a subset of it, maybe 5,000 securities that we've modeled out, we can still, to a T, provide that performance and provide that exposure to investors. And so that's an active approach to providing index-like returns. But then the way our investors are using our ETFs are not in a passive way either. Typically, they're using index funds to make active decisions within their portfolios. And in fact, some of the biggest users of our index funds are active fixed income managers. You can find our ETFs in active mutual funds. You can find them actually in many other active ETFs because they're used for liquidity purposes. They're used as tools to put on tactical risk in certain fixed income sectors, to reduce risk, to add risk. So you have this spectrum now of index, of active, of systematic, and blending all of them, both in the way you manage the portfolios and the way that you utilize portfolios. And you also asked about where are the flows coming from, who are the ones that are buying these fixed income ETFs, and interestingly, it's coming from everywhere. So again, it's large institutional investors. We see sovereign wealth funds and central banks that use them because it gives them very efficient access to large parts of the fixed income market all at once. We see active fixed income managers who use them for liquidity and tactical purposes. And we see cash investors. You mentioned there's a lot of money sitting in cash right now. We see cash investors who are stepping out of bank deposits and money market funds and diversifying into ultra short duration fixed income ETFs. And then we see traditional bond buyers and retail investors who are utilizing the fixed income toolkit to achieve their objectives. There's a product type in the market now called term maturity ETFs. We call them I-bonds at BlackRock, at iShares. And what these essentially do is they replicate the experience of owning a fixed income security or owning a bond, but through the ETF vehicle. And what it does, it provides the best of all worlds to investors that like the experience of just buying a bond, because what it does is it owns a portfolio of bonds that all mature within a specific year. It trades on exchange like a stock, which brings it liquidity, and it's diversified. It holds hundreds of different securities in that sector asset class that it looks to provide exposure to, all in one click and for a very low cost. And so all of a sudden you have the ability. I used to be a bond investor. I'm an old school financial advisor who's building ladders for my clients, but I have thousands of different clients and I had to buy thousands of different securities for them. Now I can just buy these ETFs and build those ladders very efficiently and build those portfolios. And so it's bond buyers, it's cash investors, it's institutional traders, it's dealers hedging their balance sheets. There's many players to this ecosystem that can find value in the tools that we make available, whether it's index or active.
Well, that's probably a pretty good point, too, as you sort of think generationally as things have been shifting. Probably the younger investors have gotten more accustomed to buying their bonds through a vehicle as opposed to just buying the bonds outright. That being said, there's a lot of people that are used to just building and buying their own bond portfolio, managing that, being that mechanic, if you will, to put that together. Obviously, as we said, this has truly evolved in the past decade for fixed income ETFs. What sort of advice would you give to someone that's sort of still holding on to, I just want to build my own bond portfolio, I'm building my ladders and that's it. What should they consider when it comes to using fixed income ETFs? How should they think about it, potentially incorporate it into those portfolios? Tanush, you want to start?
Yeah, I think you get the best of both worlds, as Connor described. You get the efficiencies and the technology of traditionally what's been in equity world. You're trading in the click of a button. You can trade in like smaller denominations. You can trade liquidity, bid ask, penny wide, a lot of like large liquid ETFs. So you're getting all the benefits of traditional equity investing in a more challenging asset class to trade in. So if you have that individual bond investor who's kind of managing bonds themselves, you can certainly do that, or you can outsource that to a PIMCO or to a BlackRock and buy that exposure at a click of a button, 1 cent wide. That's an attractive proposition. You don't have to deal with coupon reinvestments. You don't have to deal with corporate actions and all the other kind of operational aspects of managing fixed income portfolios.
Yeah, I think I'll come at it a little differently in the sense that if you say, okay, look, I got some fixed income bucket and I need to invest right now, what should I do, right? So that's a slightly different question, if I could reframe your question. The way we think about it, and fixed income is winning the loser's game, right? Nobody who does fixed income besides Bill Gross and a few other people is ever on television, right? The equity investors are on TV all the time because equities go up a lot. Fixed income, if you don't make mistakes, you'll stay out of television. And if you make mistakes, you're going to be on the front page. So fixed income is all about avoiding mistakes. So we think about 4 things, we should think about. And first is duration. Like, how much duration do you want to have? Because that's the most important thing in the portfolio. The second thing is, where do you want to have your credit risk, like the risky part of the thing? Do you want to own emerging markets? Do you want to own high yield bonds? Whatever, like you could buy CLOs, whatever you want to buy. So where do you want to be on that? Then the third one is in terms of structured risk. So there's a lot of fixed income products that we can buy by issuers like the folks we have here, where there's a lot of structured risk, right? Like you look at all these closed-end funds and stuff like that, where you might not want to take the risk right now because the curve's inverted. If repo gets pulled, those funds will have to sell assets. So there's all this sort of structured risk there. And then the last one is the illiquidity risk that somebody else mentioned, which is like, yeah, you can go buy some security or ETF that has private credit and other stuff in it, but you won't be able to sell it like in a panic, right? So you'll only be able to hold on to it, and you have to be willing to ride the thing. So that's, kind of the 4 pillars. And right now we think that having a bit of duration is not terrible. We like the BlackRock floating rate ETF, which is great because it's treasury floaters and index. If Fed hikes, we'll still make money on it. And then you want to have a little bit of emerging markets, right? So we kind of think that you should have a portfolio of different things. And there's no it's not like one of those things is a no-brainer trade. Like, it's not like inflation is going to go down and rates are going to rally 300 basis points and we're all going to be laughing next year. That's not going to happen in my base case. Famous last words.
I think one other interesting one to think about, thankfully we have Jane Street here, is if I am a bond investor and I want to convert, or I want to make a conversion into an ETF from this large portfolio, what should I be thinking about? What's sort of the sizing that makes sense, and how would we engage with a Jane Street or someone else on a proposition like that?
Yeah, so I think from our perspective, the one thing I would tack on even to the last question is that I personally don't think enough folks are thinking about liquidity risk in this world where they're constantly expanding what's available to them within the fixed income universe. So when you think about what's available now for a bond investor managing a portfolio, there's really 2 avenues for you from a liquidity perspective, or 3. You could engage in more electronic trading when you're looking for liquidity, in which case you're probably susceptible to some adverse trading in that dealers will price up the bonds that are easy to flip, easy to price, and the bonds that are less liquid within your portfolio are going to have less competition amongst dealers. The second avenue is going to be that of portfolio trading, where you're looking to construct your bid or your offer list in such a way that it's more index-like, right? So to the extent that that portfolio looks and feels like an exchange-traded product, that's precisely where it's likely to get priced. And a good example of that is during March of 2020, where you saw the bond market essentially start to freeze up, if not for the fact that the Fed really stepped in. But you saw sort of a situation where ETFs became the main conduits of price discovery, especially at a time when, if you look at how bond fund NAVs are being calculated, these are usually using pricing sources. Typically it was dealer bid side 3 p.m. But all that to say that the pricing sources were lagging relative to what you experienced in the secondary market for those ETFs. So of course, you hear an ETF market maker say, yeah, you should trade the ETF, it was super liquid. But more importantly, bond portfolios were also going off at that same time. And the bond portfolios that were trading very closely in line to where ETFs were trading. So that tells you that these 2 ecosystems are talking to each other. And really what the market is saying is that index-like risk is something that is easier to price than idiosyncratic risk. So the extent to which you're thinking about that as an investor, I think, is key. It's not just buying the ETF. Of course you could go into less liquid markets or think about CDX or swaps, but it's more looking at the portfolio that you currently have and thinking, how can I make this look like something that is currently more liquid, and to what extent might I get a bid on offer on that portion of the portfolio? And then of course there's sort of utilizing a fixed income ETF as sort of the liquidity sleeve, which I think increasingly you will see both from institutional investors, but also traditional asset managers, right? We've talked before, I'm sure earlier today, about mutual fund to ETF conversions. a lot of, frankly, what we're seeing on the desk is that established traditional asset managers that are coming to the market are instead opting to launch sister and brother strategies to established mutual funds. And the funny thing is that what that allows them to do is to have the PMs of those funds then utilize those sister and brother strategies as a liquidity sleeve within the mutual fund. So I think it's really liquidity at the end of the day, but it's me talking my own book.
Well, speaking of that, we've only got a couple of minutes left, so I want to make sure everyone gets as much as we can out of this panel. We can keep going for a while still, but I'd love to end with just, we've talked a little bit about the markets, a little bit about what's going on within the fixed income ETF landscape and the mechanics, all those great pieces. How about just on general outlook, and we really only have a minute or two left, not just your outlook, but what's sort of your favorite ETF in the fixed income space to capture that theme, to capture that view? And no, I'm not going to restrict you from not picking from your own firm. You're welcome to pick from your own book. But I think it'll be fascinating too. There's a lot that's been said. How do we capture some of these themes today in our portfolios?
I'll lose my job if I quote a different ETF. But I think because there's so many interesting things going on in fixed income. We recently published our cyclical outlook of global central bank policy divergence. So you have international markets which are screaming attractive. You have securitized debt which looks really attractive versus corporates, and all these fixed income markets compete for the same spot in the portfolio. So for covering a wide range of fixed income parts of this fixed income markets and the flexibility, we launched a strategy, PYLD, with our group CIO Dan Iverson as a PM on it. So I'm going to give my money to him.
Okay.
I was going to say GHMS, which is our ETF, but I'll mention that I think the overall point being that I do think that active fixed income is going to massively outperform. Active fixed income's always had some outperformance. Otherwise, those managers don't survive. But this is an environment where it's more easier to do that. I know our friend here, BlackRock. The ags, for instance, it's not really, it's an active basket and it's optimized to the index and all that. But I do think you do have to decide when do you want to have ags and when do you want to have T-flow and when do you want to have some of the other TLT on the portfolio. And that's, I think, so having active managers in ETF format, I think is probably the way to go.
Connor, I think you said you have 130 options to pick from there?
Yeah, and that's the
Pick
beauty
one.
of it. Yeah. No, I'll come back to what I said at the beginning, which is the two pieces to where we sit today, which is an incredible opportunity in fixed income, given where yields are, and the toolkit you have to play with. And all of the investors out there today can build portfolios that have solid yield and high quality without taking on too much risk. And you can either outsource that to someone like PIMCO or BlackRock, and we have our flagship active ETF, which is the BlackRock Flexible Income ETF, where we're going to take all those different sectors and allocate and provide that outcome to you. Again, an attractive yield without taking on too much risk. Or you can take all of the building blocks and you can take a look at what we did to build that and build it yourself depending on what your constraints are. So you can disaggregate that active fund and you can buy the ag and combine it with a CLO ETF that we have, with a bank loan ETF that we have, with an EM ETF that we have, and maybe some floaters and inflation protection. And depending on what works for you and what doesn't, move those tools and levers around. And that's the beauty of where we stand today.
Hugo, what are your thoughts on the market?
I'm going to be
What would you be buying?
I'm going to be a little bit more fund agnostic. I personally think that we've actually entered this sort of really weird, unique era in the fixed income ETF space that you see a lot of Me Too strategies. And it's not to say that one fund should win over another, but I think that's a win for investors in that from a tax loss harvesting perspective, you now have a lot more opportunities to manage your portfolio. And if there's anything that I think should probably be on people's tops of minds looking forward is what the tax environment looks like. So yes, there might be competing assures on this stage, but to the extent that they're releasing products that maybe are operating within the same space, that's actually a great thing for investors at the end of the day. So maybe it's not staying within one fund forever, but utilizing both.
Fantastic. Well, thank you, everybody. It's been fun talking about fixed income ETFs, and we're around afterwards to answer any more questions.